This module investigates the essentials of financial statement analysis. In addition to the highlighted topics, this session provides the participants an opportunity to explore and discuss such terms and concepts as the logic of the financial statements, how business characteristics impact the financial statements, the importance and benefit of conducting financial statement analysis in 2 phases, applying the DuPont model to enhance ratio analysis, and avoiding the profitability trap. There are essential activities involved in financial statement analysis. The activities and their sequencing are as follows: obtaining the financial statements, processing the statements, reviewing auditors' comments and footnotes, spreading the financial statements and making appropriate adjustments, ratio calculation and analysis, and financial statement analysis. Within some institutions, the financial statements are not adjusted to reflect information contained in the notes to the financial statements. Unfortunately, this practice increases accounting risk. Assessing the quality of the financial statements is crucial. Analyzing financial statements without understanding or assessing the quality of the statements is a waste of time. Assessing the quality of the financial statements involves reviewing the nature of the accountant's services. Were the statements compiled, reviewed, or audited? Reviewing the auditor's opinion. Was the auditor's opinion unqualified, qualified, adverse, or did the auditor provide a disclaimer? And an examination of the notes to the financial statements. The notes contain critical information about a company's accounting standards and practices, as well as important information regarding the company's performance and health, which are not disclosed within the statements themselves. This slide depicts a generic balance sheet and income statement. The assets of the balance sheet are characterized as current and non-current. The assets are also arranged or presented on the basis of liquidity. That is, the most liquid assets are presented first, followed by less liquid assets. The liabilities of the balance sheets are also characterized as current and non-current. The income statement reflects the revenues earned, corresponding expenses, and the resulting profit or loss. The balance sheet and the income statement are tied together since the net profit or loss reflected in the income statement is either added or deducted from retained earnings, thus increasing or decreasing shareholders' equity. Accounting risk addresses the quality of the numbers contained within the financial statements. Accounting risk can result in formulating incorrect impressions of a company's performance or health due to the accounting practices used by the company. Accounting risk is potentially present in all financial statements, including the income statement, balance sheet, and any other statement that is derived from the balance sheet or the income statement. For an example, the cash flow statement. Asymmetric information occurs when one party to an economic transaction possesses greater material knowledge than another party. Almost all economic transactions involve information asymmetries. Information asymmetry is not restricted to SME and commercial customer sets. Also, information asymmetry is not limited to the emerging markets and developing economies. Information asymmetry is a global issue that financial institutions face. Information asymmetry increases accounting risk and the likelihood that the assessment of a company's performance and health is incorrect because of inaccurate or misleading financial statements. The questions that must be asked include: how do we validate the information provided by the borrower or the applicant? How do we become comfortable with the financial statements? Are there some validation techniques that are more effective than others? During this course, a pragmatic approach for assessing and addressing accounting risk is presented.